I think the sharpest investors are the ones who are willing to change their minds when the facts on the ground change. And what we've seen over the last 7 days is a pretty dramatic rethinking of the global supply picture for energy in particular. We've seen a staggering surge in the price of oil as traffic in the Strait of Hormuz has slowed down as dramatically as it has. But I still think markets are thinking of it like a short-term disruption. I think there's still a little bit of recency bias from the 2025 Iran episode, which is fundamentally very different from this one. And I still don't think markets have fully appreciated the cost to global growth, to global supply chains, and to domestic inflation here in the United States from a persistent disruption of the straits.
So the underlying economic data in the U.S. is still generally very healthy.
Yeah.
When you look at GDP growth, we'll get the jobs data today, inflation. But this situation in Iran, I guess the market is kind of telling us we're prepared to look through it to the other side. Is that a fair assumption here? Or at what point does it become problematic? Is it 3, 4, 5, 6 weeks, that kind of thing?
Well, I think you're absolutely right in terms of what the market is discounting. The market is trying to look through it, even though these oil price moves look big. The stock market moves this week feel painful. In the grand scheme of things, U.S. equities are just at the bottom of the range they've been since October.
Yeah.
Oil's still off its heights since the Ukrainian invasion, but I think that relative sanguinity, that relative calm, is out of line with the level of fundamental risks in the backdrop here, and that's why I think paying close attention to traffic in the Gulf is going to be very important.
Eric Van Nostrand with us here. We're going to continue. Jane Foley over at Rabobank just tweaks euro. She goes weaker euro from a 117 down to 116 is her view. Right now, euro with a really difficult week, 115.62 with DXY pushing up against 100. I mean, that's consensus gets a view here. Oops, it's wrong. Like the massive weak dollar call doesn't look so good right now.
Right.
What is consensus in economics into this jobs report, into retail sales? What's a consensus call in economics where the Van Nostrand radar is up?
Well, I think you got to separate the structural and the cyclical here. And I think the structural context coming into the Iranian episode and coming into the jobs report today is that the U.S. economy has been, I like to call it more concentrated than it's been really in living memory. The way consumers spend, it's really driven by the top of the income distribution. The way businesses invest, it's all concentrated in AI data centers. We have a very concentrated set of demand factors on both the consumption side and the investment side in the U.S. And that's contributed to strong overall growth, but it's also more fragile than this level of economic growth normally is. And that's why X factors like this energy shock, the risk of a slowing labor market, and that's why we'll be watching today's report very closely, all threaten to disrupt that generally strong growth we've seen year to date.
This K-shaped economy, this K-shaped consumer, it's been with us for a long time. Is it problematic? I know it's problematic for the people on the lower end of the K, but for the overall economy, the numbers that we get on our eco screen, they seem pretty darn good. But structurally, can this economy continue with such a disparity?
Yeah, so the reason I think it's problematic for a lot of reasons, not least because of the large portion of Americans who aren't seeing the income growth that one would expect from this level of aggregate economic strength. But it's also worrying because the most persistent growth, the growth we can have the most confidence in as macroeconomists, is the broadest growth. And when it gets concentrated like this, it's more prone to disruption from geopolitical shock, which we've had an awful lot of lately, and from supply constraints. And I think this particular geopolitical shock is going to increase those supply constraints.
And before the jobs report, 15, 16 minutes away from all that data, Claudia Sam will be with us. Let me look at the list here. I don't have Nadia Lovell will be with us, UBS on the equity markets. Jennifer Lee from BMO Capital Markets, just wonderful. Benjamin Laidler, who has the mother of all calls. A guy named Kevin Hassett's going to stop by, I believe, talking to John Farrell as well. Austin Goolsby late in the show today. Right now, Eric Van Nostrand with us. Okay, I'm going to get you in trouble. There's a guy, Adam Posen, at the Peterson Institute who did a co-write with a guy named Orzag. And they have basically suggested inflation will be more persistent. Do you agree with Lazard's Peter Orzag that we are going to see a persistent wage inflation? We are going to see a persistent overall inflation, which is not in the markets at this time.
I'm happy to give you a list of topics on which I disagree with my boss, but on this one, Peter and I are in the same place. I think the markets are generally far too calm about the inflation picture. They've been kind of lulled to sleep a bit by the fact that the headline CPI has calmed down. And, Peter made that call before the episode this week. I think the oil disruption we're seeing is obviously going to juice the inflation numbers in a meaningful way. But here's the key point, Tom. It's not just the impact of the oil shock that we've already seen.
Right.
It's the fact that the broader supply picture bleeds through to a much broader global constellation of goods and services and inflation. And to my mind, really increases the risk of upside price growth.
And Peter did brilliant supply analysis here 2-3 years ago on COVID as well. So with the jobs report, last month was oops. Well, that was positive. Are we going to get another oops report here where you got a 3-month moving average, which is oops, better than the gloom crew?
Well, I think I heard Chris Waller just tell your colleagues he expects January to be revised down meaningfully. I do think January looks like a pretty significant upside outlier in the pace of job growth we've seen recently. I think it's very important here, Tom, to balance the supply constraints that have been pulling job growth down and not confuse them with slowing demand, which I think is one of the bigger forward-looking worries we have right now.
The Supreme Court recently struck down the IEEPA tariffs, but we still have a lot of tariffs out there.
Sure.
But the market, again, seems to have looked through, generally after that April timeframe last year, looked through these tariffs. What is the economic impact of these tariffs, do you think?
I think the markets have looked through the tariffs because the inflation data has given them permission to. Because the inflation data so far has been much softer than most economists, including me, by the way, would have expected given the magnitude of tariffs we've seen. Now, that's much more likely to be a delay in the tariff impact than a miss on the tariff impact. And that's part of the reason we expect an elevated risk of hotter inflation over the course of this year.
You were the Assistant Secretary of the Treasury for Economic Policy under President Biden. What did you learn there? I mean, a fancy guy like you with all your work at BlackRock and now at Lazard, you wandered by Yale to get pizza and a law degree. Wonderful work out of Pennsylvania. What was the biggest lesson learned in your public service at Treasury?
I mean, I came away from that job deeply, deeply inspired by the manner and the courage with which public servants, not just in the Biden administration, but including the career officials that worked closely with us throughout, were able to balance economic rigor, kind of understanding the intellectual arguments with understanding the way they affected human beings.
So if we pop 3 months, this is like an Orzak question. If we pop 3 month moving average, sub 100,000 non-farm payrolls, you're telling me that's politically acceptable?
Absolutely not. I think the slowdown in job growth we've seen over the past couple of years is evidence that it's evidence that some of the shifts we've seen in the way the labor market's been able to grow, some of the tighter constraints imposed on supply by immigration policy in particular, are resulting in lower growth than the United States would otherwise be able to deliver.
This is like gossip with Taylor Swift. What's the thing
That's
you
the
and
first
Orzak,
time I've gotten that one.
What is the thing you and Orzak are most not on the same page on? What do you argue about?
Now you are going to get me in trouble. I think the conversation of Lazard, we always describe the conversation of Lazard as being about contextual alpha, which is we do our quantitative, rigorous work, but we put it against a backdrop of what's going on in the geopolitical environment overall. And I think that mix of qualitative and quantitative is really at the center of how we develop views, but also creates a lot of debate and creates, I think, a lot of open questions about whether the Supreme Court's ruling on tariffs creates more or less uncertainty. I think right now, I think it's a good thing they did that, but I think
we'll sum it up on the back of a 3x5 postcard. Do we get solid GDP out of your contextual reality?
I still think this year is more likely than not to deliver above potential growth
there we go.
overall. But there's a lot of risk, Tom.